Now, Statistics South Africa is scheduled to release its gross domestic product figures for the third quarter tomorrow, with analysts hopeful that the data will point to signs of a strong rebound after the country's coronavirus lockdown and South Africa's economy contracted by 51% in the second quarter. Joining me now to examine this is independent economist Ntombi Mbele. Ntombi, good evening and thank you very much for your time on the newsfeed late night. We are expecting the numbers tomorrow. Are we likely to see some kind of a rebound?
Good evening. Technically so, yes. We are expecting a rebound, especially from the record low number, 51%, which you've just alluded to in the second quarter of 2020. So the consensus view is an uptake, but different sources have different degrees of it. So you've got Bloomberg, which interviewed a host of economists, and the consensus view was that around 54.3% will be the uptake view of the rebound. And you've got the Reserve Bank, which believes that, a more conservative, just over 50% rebound is what we are likely to see in terms of the GDP uptake tomorrow.
Yeah.
And you've got, factors. Yes.
Yeah, what are the factors? Where is that rebound going to come from? Because by and large, we know that the retail and hospitality sectors have not fully recovered.
Yeah, that's correct. Of course, they have not recovered, especially the hospitality sector because of the hard lockdown restrictions that were there. But interesting to note to you is that we have really a life angel and a saving God in the agricultural sector, which in the previous two sectors and two quarters rather, it has been the lead sector that has been really dragging the SA economy into a more positive terrain with figures such as 28% and over 15% in the past consecutive quarters. So that's really has been the only sector that has really been strong, and attributing that to heavy rains and positive harvest seasons currently, that's the only reason, only sector really that one can positively, with confidence, say that you can expect a positive contribution and a significant one towards the GDP number.
So I suppose food remained a necessity even in the time of lockdown. Families had to eat and families, I suppose, sought that all important protein as well. But tell me if that would in any way signify a kind of a recovery in the economy that would see our GDP not shrink as far as 7% or 7.5% as Treasury predicted. So,
you rightfully mentioned the protein that households need. Interestingly, you've seen that food inflation, especially during this seasonal December period, when in particular looking at meat and meat produce, you find that there's going to be a lot of kind of demand for meat, and that will drive up the price. And for households that are constrained, which is probably majority of the economy, this is something that is of concern. But see, agriculture is not only the sector which can kind of salvage what's been going on in the SA economy, even pre-COVID. What you realize is that sectors such as manufacturing, such as mining, might see a positive in terms of growth on a quarter-on-quarter basis. But what you realize is that it's not significant enough as a result of inability to make or to produce or for production, as well as other exogenous factors such as export and border controls in terms of you being able to kind of put out your product in mining or even in steel. So those are the two also very important sectors that are likely to, are in the fence really, but knowing for sure that the significant contribution will not really be there tomorrow.
Financial sector
not
hit.
To the degree.
I was saying the financial sector. The financial sector was hit quite hard with the top 5 banks really seeing their numbers quite low, particularly with customers unable to repay their debt during the time of the lockdown, and they're expecting a lot of defaults. Is there any improvement on that front?
Not as yet. Unfortunately, not as yet. Instead, what you see is that there was a study that was actually taken by, or produced rather by TransUnion, which monitors the activity of households being able to repay their debts on time as per the agreement. And what you then find in that study is that households have actually said that they have a 7,000 Rand, on average, 7,000 Rand shortfall in terms of being able to pay back their obligations and their debt. And you find that households who are very privileged to have investments or some even tap into their retirement to be able to meet the shortfall between what they're earning and the lowered income that they've had to receive and adjust to, as companies had a lot of salary cuts this year. And so people are resorting to other means. People are resorting to, using their retirements. When you look at what happened on Black Friday, BankServe showed how people were not really buying on cash. People were using credit to facilitate their Black Friday spending. And that is indicative of the strenuous nature that household income is in right now.
Now, in as far as the vast improvement, I mean, it is expected that we will see some kind of improvement in quarter four, but is there going to be much of a difference in quarter three, and will that be a difference big enough for the rating agencies at least to get off our backs a little bit?
I think that would be a far-fetched dream to think that this quarter can, in any case, kind of almost, wishfully eradicate the previous quarter's performance. And also, when you mention the fourth quarter, that will also be, because of spending and seasonal spending during the festive season. So you also have to adjust that and compare like for like, and not use the fact that people had some form of, increased spending during this time, and that could have at least, kind of informed them into buying. And what should be, the very honest understanding of tomorrow's numbers is that households are still very constrained. Demand is still very low. And if demand is low, which is the fundamental factor or fundamental block into building an economy, output growth will ultimately also be low.
Well, I mean, looking at Brexit is still with us. It looks like the UK not concluding on that particular matter. The dismal way in which the United States has handled the COVID-19 pandemic. But also you're hearing some good news coming in as far as the vaccine is concerned. How is the currency responding?
The currency with regards to the vaccine is a bit more optimistic, but you must realize that the currency right now is also being driven by exogenous factors and not really our own doing, but because some of our global partners aren't doing as well. So because they're not shooting the ball, we kind of, in a playing field, you're still being able to kind of, fight for our way in the currency space. But I can tell you that there has been a positive sentiment with regards to the possibility of the vaccine. However, the question of availability to the masses and not to a select few that can afford private healthcare still remains a big concern. And that's why it is that, people are wondering who will administer this vaccine. Will it be private or will it be publicly done? And if it's publicly done, can we even afford it? So there's so many questions, when it comes to that. And when you look at Brexit, it's also the uncertainty when it comes to, do you maintain the contracts that you have with certain suppliers or buyers of your product in those terrains and in those in the UK economy? And so that becomes something that, as a supplier or as a business person, you can't be in limbo. You can't make business decisions, strong financial, long-term decisions on an uncertain economy. And so even though that might still be benefiting us in the short term in terms of currency appreciation, in the long term, it stands to harm us more than we actually imagine.
But I suppose the stronger rand, in a way, I mean, how does that play to foreign direct investment? I know we've just had our investment summit virtually not so long ago. Are investors rushing to buy businesses in South Africa?
I would wish to say with confidence that that is true, but you also realize that there's other factors that kind of impact that. And it is not only the rand or currency appreciation in the short term that, and as a result of things happening outside of our economy, that would find us being able to have and house businesses in SA. However, you find that, on the inverse, you find that businesses right now would also realize that our yields are still more profitable than most economies. And because we are an emerging economy, we still are a bit more attractive than a yield of a US Treasury bill. And so that is something in the short term that we can still leverage on and we can still make some form of gainings from. But in terms of long term and us being able to house businesses, there is the concern of mismatch of skill in this economy. There is the concern of very strong and rigid labor conditionalities that come with having a business in South Africa. And so perhaps because we are part of BRICS, there could be some leeway that is used for us. But in terms of just the merit of the rand, for example, or even the fact that we have positive yields currently is not perhaps the strongest indicator of us being able to house businesses for long term with our current economic domestic problems.
Ntombi Mbele, I appreciate your time tonight on the Newsfeed Late Night. Independent Economists, they're helping us with those numbers as Statistics South Africa tomorrow releases those GDP figures. So we'll be bringing you more details on that and analysis in our coverage tomorrow.